All right, welcome everybody. We are about 1 minute away. I just want to make sure that the recording, let's see what we got. If audio is good. Is audio good? Audio, rock and roll. Oh, General John, good to see you, man. It is rock and roll. Kind of ironic. We've got a lot to go over today. I'm going to do a slight review too because you know, between your Facebooks and your only department store that most people shop at nowadays is Amazon, right? It's like, I guess the only reason you'd go to the mall now is to get a custom tailored suit. And well, I don't know how many traders sit in front of the screens with custom tailored suits. That's a joke. Anyway, we'll try to make heads and tails of what's happening and do a quick review of where we've been the last time a lot of you guys were here last, well, gosh, it was only 21 days ago, 3 weeks ago. It was 3 weeks ago that we spent time together if you were here. I like to make sure the shoes fit. I get you there, Tom. Yes. Shoes maybe, the right style. You know what? I take that back. It's not all Amazon, but needless to say, how many people were here when we did our the webinar on Thursday, July 7th? And again, who can remember if you had a cup of coffee this morning, for God's sakes, right? It might be a tough one to remember, but I'm in a fairly good mood, as you can tell, for several reasons. We've had a pretty good, well, I'd have to say year. And as we get into the presentation, and based on just about today's close, and this information's I'm gonna share some of the old slides, by the way, in last month, and go where we're at right now. So live, Memorex and live. So we'll do a little bit of both, and then kind of give you guys a little insight as to how to handicap where we're going to go from here. One other thing I have in store for you while I sip on a hot cup of coffee is, how many of you saw the tweet that I sent out today? Stephen, if you remember the 70s, then you weren't in the 70s. You cannot remember the 70s, supposedly. You didn't see the tweet I sent out. And well, all right, and then in the trading room today, some of you guys, if you were in the trading room, I went over, I thought it was, and I had lunch with a good friend of mine, Jeff. Some of you are familiar with Doc Scott, who's helped with the create and founded the Pug Users Group. He's just an individual trader, independent trader. Some of you guys know Doc Scott. Maybe you've met him at trade shows, whatever. But anyway, we actually tickled pink for him, the right strategy on for a little hedge on Amazon, and he's going to be loving it. So, all right, so let's get going. I think we're here. Let me just go through and see, first and foremost, what the heck I was talking about. I don't want to ruin and jinx myself by introducing something, but on our website, if you go to Twitter, and generally I don't really tweet a lot of, what's the word I'm looking for? I don't get political as much as I'd like to. I'm married for 28 years, and the reason, no, I'm married 29 years, excuse me. The best way not to make 30 years is to not remember how many years you're actually married, by the way. So I had to share this with you. I'm going to go over this today. I sent this out 4 hours ago. So when was that? Gosh, noon, 12:30. I sent this out. Many of you guys may know exactly, and we're going to go over this slide, but I wanted to say this. I discussed in the webinar, as promised. I wanted to do that. And since no one really saw it, maybe we shouldn't talk about it. But since I said I was going to talk about it, we will. But anyway, this is the tweet, some things that we put out. And we put out some pretty decent information on the tweet every once in a while. I've calmed it down a bit. I used to put out a lot of alerts on HCDs and LCDs. And anyway, we'll discuss that in a few minutes. Let's take a minute to just go over this disclaimer. Trading's risky. Many of you know that. If you didn't know that, trading's risky. Okay? So here's what it's about. if you're day trading, I can tell you this presentation, just log off right now. This has got nothing to do with day trading. This is more using some techniques and tools for macro, some stock trading, and directional techniques. So this is not going to be triggers for short-term mechanic trading. So if you thought that we were going to go over mechanic and day trading opportunities, wrong webinar. All right. So I just wanted to save your time and so that you don't get into that. All right. Now, here's the deal. I think it's important to combine the right indicators in your market analysis, and that's something that we've kind of done. It's not one set of indicators, even though many of you are quite familiar now with the PPS indicator, and a lot of you have given me some phenomenal feedback. People have actually sent me charts of their work. One webinar, I overlaid that to with an individual. It took a lot of time going through it. It was amazing, and I respect that. People that take the time to say, John, I learned this from you, and this is it. Or as we did our web seminar at sea, we were just in the last month in June in the Mediterranean on an investment seminar we gave, and an individual said, you know, I bought your book and I back tested you before I ever saw anything. And it's like not many people say, I bought your book and I back tested you. It was a very it was an interesting thing because it just shows that people are, you know, still interested in A, trading, and B, doing their due diligence. That's awesome. More importantly, a lot of people gave positive, phenomenal feedback saying, hey, your indicators have really beat out some of the more popular ones, and they give out cleaner, faster signals, more reliable signals. And that is something I've already known, and I'm sure you may be discovering that within the PPS indicator. Many of you will find that, of course, if you're Thinkorswim traders, you find that on TOS. But it's not just about one indicator, a momentum indicator. It's about uncovering the condition in which markets go. And so I think that's important for trading indexes right now. And we like to go down and look at the sectors. What's really making these markets move? We have a bit of a divergence happening lately in the last 2 weeks, where you see the NASDAQ outperforming and the Dow's not performing. It's underperforming. Large cap, high dividend yield stocks, look at consumer staples, are starting to fall off their high. And to me, that spells market is going through a metamorphosis where we're starting to see people that were all locked up and just buying high dividend yield stocks to get that extra income boost. And they're starting to change their ways right now, which is really interesting, especially this time of year. So I think what we're going to share again today is to say, first off, what did we do the last time we were here, and what does it compare to where we are right now? And more importantly, how to pick stocks these days, because that's kind of important. Now, these webinars are recorded, and you can go through and get the link on our YouTube channel to get the recording. In fact, if you log out early or something's going on, then this presentation will be recorded for the record, and you can go back. So when we met on right after the 4th of July, we came in here to talk about where we're going to go for the rest of the month. At the time, the S&P was up 3%. We had all these big concerns to worry about. Diamonds, the Dow Jones Industrial was only up 2.8. The Russell, the IWM, was only up little over 1%. Here's the red is obvious. The Qs, the NASDAQ, composite, transports, all negative. Bonds were up almost 20% year to date. So what happened this month? Well, from the beginning of July, some of my comments that I've written started off with big name stocks like Amazon, Google's looks like you can see further upside in the near term. Other component stocks like O'Reilly and Costco populated monthly high close doji patterns. And you know what? That's a very powerful statement. We've seen a liftoff in O'Reilly thanks to their earnings, but it started to move up with a lot of other auto and truck parts stocks. And another one of my comments was, if we combine the positives here, we have a strong argument that we see the NASDAQ lift off to test last year's high, which would translate to another 6% move from Friday's close. This comes from my weekly thoughts and observations, my comments from 7/4. I shared those comments in the presentation I did with you guys July 7th. So what's happened? Holy moly. As of about 30 minutes ago or less, or 45 minutes ago, whatever it was, The S&P 500 year to date, guys, is up almost 8. Who would have thought in January that the S&P mid-year would be up almost 8% year to date? The S&P SPY ETF up 7.59% year to date. Diamonds are up 6%. The Russell is up 8.46% in 3 weeks. Let me go back a slide. The Russell was up 1.26%. It's now up 8.46%. A 7.25% rise in 3 simple weeks. So I guess there's an argument that says if you're not in the stock market 1 week, 2 weeks, 3 weeks out of the year, you're going to miss the bulk of a stock market rally, which is why a lot of fund managers and investment advisors say, don't be out of the market, because there's going to be a time where you're not in the market and you're going to miss that big surge. Well, certainly come into July, that seemed to be true this year. The NYSE, the New York Stock Exchange Composite Index, up 6%. Qs, you know what's funny? We've gone from being negative. Let's review this, guys. So why is this? First off, let me tell you why this is important. If we're going to figure out together in just a few minutes where the market's going to go, we got to ask ourselves where the hell they've come from, right? If you want to figure out where something's going to go, ask yourself where has it been and how did it get here? What was the condition of the move? How fast did the move take? So there are reasonable questions as to why I'm doing this. The Qs right now up 3.5%, 3.48%. The Qs were down 2.6. So if you add 2.6 and add that to what? 3.48. Heck, we are literally almost up the 6% move that we said from July 7th. So we almost got, we're pretty much at that target. Give or take, markets kind of overshoot little runways. The NASDAQ right now, the NASDAQ composite that is up almost 3%. So we still got a little ways to go for the underperformance of the technology sector. A lot of people would think that the Qs and the technology sector really took off. It's actually underperforming the broad-based market, S&P 500. Why is that interesting? Because this is up 7.8% right now as of like an hour ago, I guess, right? It's up almost 7.5, almost 8% right now, year to date, with energy prices and the XOP components, the XLE and staples off their highs in the last 2 weeks. So imagine what would happen if energy starts to get a quick pop. We could go up a little bit more here on the spiders. As you know, energy doesn't really affect the Qs much. But energy, healthcare, small cap biotech stuff can certainly help out the Russell. To me, that's something to consider going forward. So let's do a little house cleaning. We do have a seminar. If you guys are interested in learning stock trading techniques, analyzing the markets, we have what we call the Trilogy Trading Method seminar. We focus on the Trilogy Trading Method using the PPS indicator and, of course, 3 other indicators, which the power of 3, the Trading Trilogy Method. If you're interested, just go to personsplanet.com/Florida Seminar, Florida Seminar.html. I'll put that in the room in just a few minutes. All right, but I just wanted to say, hey, if you're interested in finding out and saying, hey, I'm going to be down in Florida, or I want to be in Florida, and I want to learn a little bit more than John, this is where you could do a 3-day seminar. It's Saturday, Sunday, Monday. We're going to go over extensive information and trade on Monday and get ourselves situated for the last and most important quarter of the year. So this is one of this would be the only seminar that I'm giving for the rest of this year. So like many of you go to the Traders Expos, I will not be at any of the Traders Expos. In fact, I'll be out of the country for a little bit in October and November. I won't even be, which is a shame because many of you know, you've seen me many times at the Traders Expo, a fond of them. Kim Giffler is an amazing woman, runs the shows, and it's always nice to see people face to face, but we will not be there this year. So if you want to get a little bit more in tune to the right trading methodologies that we put out, this would be your opportunity. Come see us, and I'll put the link in there, and you can figure out more information about it. Okay? All right. So I just pointed out that the market's almost up 7.5% year to date without energy. And last time we were here, I actually put this in. I said crude oil tends to be choppy in the third quarter. This is a seasonal aspect of the month. Look at July, and this begins August. Okay? Looking at the calendar down below. So typically, crude oil prices do go down until about, give or take a week, about the third week of July. Ironically, we're in the third week of July. So we're not really expecting to see the market really accelerate, but we could see a little bit of liftoff going in the next week or so, a little recovery in energy, and short term, if the market played out to this seasonal map and everything stayed the same, which means nothing went down, nothing really rallied except for maybe energy, the energy weight on the S&P would cause the S&P to maybe go up another 0.5 to 1%. If we just get the XOP and the energy components stocks back to where they were from 2 weeks ago high. That's a powerful statement. That's a keen observation. And it's got a lot to do with what I'm about to show you in just a minute. So while we are looking for energy to be choppy, I'm not looking for energy prices. In fact, natural gas is moving up. I don't know if anyone's watched natural gas lately. Nat gas has gone up. Big move today. Energy prices, crude oil back down. But we're not seeing a mass destruction in a lot of energy stocks. In fact, one of our recommended longs from 3 weeks ago was Pioneer Natural. PXD is the symbol. It's had a nice performance, and we'll get to that in just another minute. It's important for you guys to know, I think the first and foremost thing I'd like to share with people is what makes these indexes tick. When do you want to be in the Dow? When do you want your money to work in the Russell? When should you be in maybe the S&P 500? When should you be in the Qs? These are all very important questions, and it all depends on what sectors are moving at the time, right? And so I think if we think logically, we need to watch strength in numbers, the breadth. We need to look at what the increase of positions are doing over time. And that kind of looks like increasing of position over time equals a volume accumulation. So is the market rallying on volume, right? What does the seasonal sector analysis look like? What sectors will go up? What sectors go down certain times of the year? And again, run scans for buy signals near support, and you run scans for sell signals near resistance. So if the market, if you know there's a lot of markets or segments of the market that are near like monthly pivot resistance, why wouldn't you go and look at a sector and run scans for sell signals in that sector? So think of what I'm talking about there. And I'm going to, let's see if we can do this right. I want to just kind of focus on these 2 bullet points right now. All right? I'm going to focus on these 2 bullet points right this second with you guys and think of what I'm saying. So let me get up a chart. And what we're going to do today is we're going to use Thinkorswim. Okay? So the first and foremost thing, I'm trying to get it up, so bear with me. And cross your fingers. And oh my goodness, it works. Technology. Knock on wood, kids. All right. Now, I got the Russell futures. So let's take a look at the first and foremost thing we're going to do is we're going to go up here. And again, we're going to focus on that statement. We're going to studies. I'm going to add a study. I'm going to go to my name, which is John Person, and I'm going to go to Person's Pivots. As soon as I click on Person's Pivots, it defaults to daily pivots. Now, if I have a daily chart and I got daily pivots, it's going to look like this, right? So I want to go to Studies. I want to edit Studies, and I'm going to change this over here. Go to the wheel, highlight Person's Pivots, go to the wheel. Now, let's change where it says time frame, inputs, time frame. See how it says day? You're going to take the drop-down menu, expand it. You got an average of 2-day pivots, an average of 3-day pivots, an average of 4-day pivots, the weekly, the monthly, and one thing that we did that no one else thought of was option expiration, because a lot of stocks and indexes, instead of looking at month-to-month, calendar month, we look at option expiration time frame pivots. Think or swim? You guys, we were the first ones to put this here. Pretty evolutionary for technical analysis or analysts that use pivots. But right now, I'm just going to throw up monthly, just the monthly pivot, and I'm going to hit OK. I'm apply and hit OK. All right, so first and foremost, we have the Russell Futures. So I'm going to change from Russell Futures to IWM. Why? Quick lesson for you guys. Devil's in the details. Remember that. Devil's in the detail. The Russell, every time we roll, think of it this way. You roll from December to March. There's been a discount premium between the front month and the back month, right? So between March and June, and then we're going to get ready to change eventually, pretty soon, next month, from what? As we get into August, because September is the next one, we're going to change, believe it or not, from September to December. So that rollover premium discount factor, we eliminate that by going to using the ETF, because the ETF does not have that discount of the futures that we see. But needless as that is, you can clearly see the person's pivots over time for the month. I mean, it's kind of ironic. It indicated a negative time frame at the end of December. Boy, that's an understatement. Negative. It projected a higher low, a lower high in as we got into March. A bullish, a bullish, a bullish. It came back. This was Brexit, pretty wild. And then now we're trying to formulate in the Russell. We're near pivot resistance. Okay, great. That's in the Russell. So that's not specific enough for me. That's just a broad-based index. What about the XLP? John, I mentioned the XLP. My gosh, the XLP came close to monthly pivot resistance, but not close enough. And look at the XLP, consumer staples. They've actually, consumer staples doesn't look anything like the overall market, does it? It really doesn't. It looks pretty horrendous. So we're not there. Let's take a look at the industrials, XLI. Now, here's what's interesting. We have a sector, and we can go and look at the major sectors themselves, and you can see that we are at what? Chopping around at pivot resistance. We're slightly above it. So now we have a kind of a rally here, and we got a hint that volume's kind of, it's not a great strong rally. It's not like we've rallied on strong volume. We're kind of starting to weaken up a little bit. So here's what I'm showing you guys. We can go over here to scan, and I'm going to go to scan in by industry. What were we looking at? Industrials, right? Scan, select all industrials. Instead of looking for buy signals that support, I'm going with what? I have to go to license study, and I'm going to go with sell signals and scan. Now, this is exactly what I mean by defining opportunity. I want to find out what stocks, and we can change this, price to capital. We can add another filter in there, but you get the idea, and that's what I wanted to bring to your attention. What did I mean by run scans for sell signal near resistance? So I wanted to actually go through the exact details of what did I mean by that. All right? So that's kind of pretty cool, right? And I think when we're getting into a bullish environment and you see stocks that are, at least the sector ETFs are near its monthly pivot support, I'm going to start to run scans for buy signals. What kind of buy signals? PPS buy signals. What kind of sell signals? PPS sell signals. So this is what we say is another version of quantifying this, guys, strength in numbers. the more sell signals that I populate in specific sectors near resistance is telling me strength in numbers in the degree of weakness. And so therefore, I can start to define a directional idea not based on my opinion, but based on testifiable evidence that more and more stocks are generating sell signals near resistance. So I hope you enjoyed what I've shared this before, but I don't think in webinars I've actually gone through and explained exactly what I meant by that. So I hope this defines what is sell signals near resistance mean. Resistance can mean, well, I'm going to go with 60-minute sell signals against daily pivot or weekly pivot. I'm going to use maybe daily sell signals at monthly resistance. Well, how do you know something's at resistance? Well, just go through and run a scan, and I just shared with you one real easy way of doing it. Okay? Now, let's talk about this market that's up nearly, if you don't mind, do you mind if I round up a little bit and just say the S&Ps are near 8% year-to-date gain? I mean, or that might irk people, but so I'll just keep it at 7.6%, right? So the S&Ps are up almost 8%. How's that? And from a year-to-date perspective, someone asked a question. Why do you think this rally happened? And I love that question. John K., I hope you're still with us. Why do you think this rally happened is the question on the table. Well, beginning of the year, and to be honest with you, I don't remember which bank, which analyst, which guru, which pundit said sell all your stocks here in January. I don't remember. It's not important. But why did the market, how did we get from here to a disaster down there? I think there was a culminating of different things. We had a lot of fear in the market, a lot of unknowns, when's the Fed, the tension had been building with the Federal Reserve expecting to raise interest rates. They did it in December, and people had profits in, and instead of paying for, if you are in a profit and you sell before December 31st, and right about there is when you have to write a check to Uncle Sam for your capital gains. Okay, so if we wait till that day, then I don't have to, I can defer for another year and change, right? So the point being is, I think that seasonal tendency of the tax deferment selling, the January break as it's called, took place. Selling begot selling, and people got scared. Energy was collapsing, and everyone was calling for energy prices and crude oil to go to 20 or maybe 0 even. I don't know. But I'll take you down memory lane. There are a lot of different factors, but the main one was yield, interest rates, right? We started to see some inherent weakness in what was going on in Europe as well. So as we get into the year, the strength in numbers, we started to lift up where a lot of sectors, while they're still negative, this black line is the zero line. That's what this represents. That's the starting line, the zero line. Number one, strength in numbers or weakness in numbers. More sectors were negative on the year, and only utilities were positive. That's this strawberry color, okay? And then what happened? As we got into late February, more sectors started to lift off. This orange color was XOP. Energy started to come back. And so sad for those that were bearish. This is, again, IBB. I have it color-coded. They're all listed up here, but they're also tabulated there to kind of give me an idea. If I want to figure out where a market might go, ask yourself, where's the market been? More importantly, if you want to identify sector leadership, something like this will tell you exactly what's leading the market. We have gone from right about Brexit, where everything started to go down, and we had like a 2-day slide, and then everything came back. As you note, biotech has been in this kind of like range all year, and we haven't really broken out of the range. This chart that I'm sharing with you is from about an hour ago, so it's not accurate it's accurate as of just about an hour before the close. Now, utilities coming off a potential M-top formation. What does that mean? Utilities went right now, they're up 21% year to date. Semiconductors. Obviously, look what launched the market, the SOX, the SOX. The semiconductors are up 17%. Financial, the XLF, it's bunched to just slightly positive on the year. Regional banks right now are struggling and just losing less, a lot less. So we have fewer sectors that are negative on the year, more sectors that are positive, and the sectors that are positive are gaining some traction. So the question I put on the table is, if you take a look, XOP right here is this orange, heavy orange one right there. If XOP gets back up, if the XLE or the OIH component trade back up, and everything else stays the same, God forbid, and the IBB gains a little bit more. Instead of being negative 15%, maybe it only goes to maybe down 10% year to date. Regional banks and the financials gain a little bit. Where will the stock market be? So we get this term called sector rotation. If people feel comfortable that they don't need defensive plays, utilities is defensive, staples are defensive. Did Philip Morris, did Altria, were those stocks up because they're selling a lot of cigarettes, or are they up because people like the dividend yield because it's safe and they didn't trust the market? So if we see money coming out of utilities and out of consumer staples, the XLP, which is starting to see downturn, it's right in here. It's off its highs. I already showed that to you. And if it's replaced with more people buying computer hardware and technology, which is exactly what we've seen. The black line is the XCI and the blue line is technology. Guys, we have a shift, an internal matrix shift in the market. And what does that come and show me? Interest rate changes. Now, the first step in normalizing interest rates on a global scale is for the central bankers to stop lowering interest rates and stop the quantitative easing process. Now, Japan's different because it's, Japan. But Bank of England, after Brexit, they could have lowered interest rates, and they didn't. The European Central Bank didn't lower interest rates, and they could have. Should they have? I don't know. But the moral of the story, Janet Yellen, we just had an FOMC, and I think the market is actually getting, as we see jobs kind of recover and we see all things getting a little better, not worse on the Eastern Front, it opens the door for an eventual rise in rates. Presidential elections coming up, people are figuring out, you know what, if we get a change of head of state and policies could change, we better adjust our positions. And that's what this market's undergoing. It's going through a sector shift. And I'm not saying this because it's my opinion. I'm seeing the colors tell me that. And that's what's important, sector shift. So I think if you're going to put money to work at the market, and I understand that a lot of you look at as option traders, you look at option matrix, and that's important to a degree, implied volatility, historic volatility, but I think it's more important that you get a better sense of direction of tape reading skills of what's going on rather than just looking at crude oil, the US dollar, and S&Ps. I mean, those three or bonds, those four groups can or cannot go in sync or all the time, or they can go through a decoupling phase. Now, I didn't want to confuse you what I said there, but stocks can go up, bonds can go up. If the dollar goes down, depending on crude oil demand, crude oil can still go up. And depending on what's going on abroad, people may still want to buy gold. And so a weaker dollar is kind of good for dollar-denominated based products because a weaker dollar makes it more affordable to buy those. A strong dollar causes things to go down. Well, the dollar's been rising, so why is gold still up? So you see, my point is that, and bonds, for example, stocks are up and bonds aren't crashing. So I think we have to identify and sometimes trade the markets on their own accord. And if you're trading equities, and that's what I said, the beginning of this presentation was about equities, and it's important to look at the equity market as a whole. What's running the industrials? What's running the materials? What's running the market? Look at this, folks. Look at this Barney Cobbler. If you got grandkids or you got children, Look at the semiconductors. I mean, that is a huge whale of a move, 16% in less than 4 weeks. A 16% move in less than 4 weeks. So what I would say is that the pace of price change, we went from 0 to 100 pretty much, right, in 4 straight weeks. The odds of it continuing to go straight up are probably slim to none. We may have run out of momentum on the semi sector, all right? So identifying where can things go, I didn't say they're going to crash, I just said that the ascent or the pace of change is going to be hard to imagine that this thing continues much more aggressively. Does that make sense? Change, what's the pace of price change? Now, let me identify something with you here. This is the S&P 500 spiders. And yes, this was taken to 1693 in the spiders. So this was taken over an hour ago. This is exactly where we started the year. This is the zero line. This is the performance line. And at the end of the year, this is where fund managers say, did you beat the S&P or not? If we go to persons, this is a quarterly pivot resistance. If we get up to quarterly pivot resistance, it targets 219.28. We're trading at 216.93. A move up there puts the S&Ps at an astounding 8.79% year-to-date gain. Ask yourself a question, and this is what we need to ask ourselves. Does the market, the economy, GDP, substantiate a move close to 9% in the S&P 500? And would, if it does, then would the Federal Reserve not move to adjust interest rates? I think they would be forced to. And if they change interest rates, it will affect interest rate component sensitive sectors in the market. So therefore, the stock market probably won't stay there. If you want to figure out where a market might go, then ask yourself, where has the market been? And where is it on a year-to-date percentage? And I think that's where people start looking at the market in terms of percent change, rather than, oh, we were up a little bit today, okay? So when I look at a market, I go, well, currently we're up just a little. I mean, we got maybe, if we get up to that quarterly pivot resistance, I mean, that's another 1.25%, 1.5% to the upside. And what could we see if we saw just a small pullback? If we saw just a small pullback between, let's say, August, September, October, November, December, in the next, say, 5 months, is there a shot that we could pull back or, at the very least, stop the ascent? So we have a very slim margin. I'm filling it in red. A very slim level of upside move in the market, and probably a very realistic pullback to the downside. So buyers here, we might see a little short-term upside, but over time, going into October, my guess is that we have a more significant downside move. The rally, the condition of the rally. Gee, John, talk to us about the condition on the rally. How has this market behaved? Has it gone up on significantly strong volume? And the answer would be, according to this indicator, no. Stochastics. It's an indicator I've used since 1980. I worked for the guy who created it. His name is George Lane. He passed away. You know, stochastics, if you traded back in the late 90s, you would know that stochastic can stay above 80 till hell freezes over. I mean, it really doesn't generate a sell signal until we get a KD cross and back underneath 80. And then you start to see some maybe relative weakness, okay? So it needs to, as you can see, it can give you some false readings, and that's one of the traps that people fall into. So it can stay overbought till hell freezes over. The two things that I would look at is A, where's the pivot target, and A, has the pivot targets been effective in identifying both the condition of the market and the trend? And so far, the answer is yes. B, this is another indicator called breadth. It's the advanced decline relative to just the S&P 500, all right? So the breadth indicator, while it is strong and it showed a nice breakout of this overall channel, in the last week and a half, 2 weeks, let's say, it's starting to show signs of rotation, meaning it's starting to come out a little bit. So my take of the market is, obviously, without really a lot of volume in the zigzag, I mean, the market could go up maybe another %, 0.5%, somewhere up there. We could get up to that targeted resistance. That wouldn't be uncommon. But I'm not looking for the market to have a sustainable move to the upside moving forward. And I'm thinking that we'll see a correction as we head into October. Now, let me go over and just share with you the tools that I'm going to be watching. And I already alluded to, I'll be looking at all these indexes to see are they at their respective pivots, and are we generating more sell signals. And as you can see in the S&P 500, or at least the spiders, you do not see a PPS sell signal here. Bizarre. We've gone sideways and we've yet to generate a sell signal. The last signal was a buy signal way back here. We have not generated a buy signal, a sell signal yet. So that leads me to this slide. So what's funny is, yesterday we started to implement near the highs, a very small start to implement, because I believe the rally's running out of steam, but we do not have a sell signal. So very simply put, I was starting to implement some wide vertical put spreads in October, taking advantage of high price, low volatility. Except for today, while the market was down, I was telling people, don't be selling in the hole here. In fact, if we break out a back above pivot today, the pivot point on a daily basis, we could see the market launch to the upside. It's exactly what happened for a quick little trade. Now, at around 12 noon, I noticed this on the board in the options. This is the August expiration, all right? And I wanted to screen capture this just in case information went bye-bye. Now, this means that we have 22 days in the August 16th expiration. I want you to focus on something that I look at, and I don't like to trade to copy others' trading. But I'm looking at the market with what? The idea that we could get, let's go back here, because this is kind of neat stuff here, folks. Look at my quarterly pivot resistance. And if we get one, we have a sideways market. Is the market capable of a quick pop and maybe a drop, right? I mean, after all, we've seen markets that go in sideways. They pop and then they drop, correct? So it's not uncommon to see a market, maybe after a little uptrend, maybe we pop a little bit and then we drop in the short term. And in the next 2-3 weeks, that wouldn't be a surprise to me. So when I look at the market and I see this, I love this strategy. So a trader put on, I mean, around 100,000. Look at what else is 100,000 right here, 101,000. So I'm gathering to say that someone probably bought the 217.5 calls, sold the 219.5 calls. And probably did that for about 80 cents. All right, somewhere around 80 cents would be my guess. $1.60, you know, and about, if you look at this, 77 to 79, too wide on a spider option. I'm thinking they probably, would you say, bought this spread. You could have probably worked at it, what do you think, 80 cents? I'll throw it out there, 81 cents. So if you bought this and paid 81 cents. Now look at this. The next strike up is the 220s. And that's about 203,000 and then 210,000. So my guess is, I'm going to bet they did this 2 times. And they probably sold the 220s and bought the 222s. Why do I say that? Because these are approximately 4 strike wide. This is approximately 4 strike wide. And what they're doing, this is 1 time, that's 2 times. So they sold twice as many as they bought. And they did that spread for about, take a look with me here. You got 63 cents and you got 27 cents and you did that about 30 cents and you probably got this trade off at maybe not quite break even, but darn close to maybe 20 cents 100,000 times. More or less. That's a very unusual trade, kids, in that August expiration on a day like today. We don't really see those kind of volumes on an individual day, especially when the market's been moving sideways. Yesterday near the highs, I noticed that someone, after we did our trade, someone did a 10 wide September 212, 202 vertical put spread, 10 wide. So it's some hedge funds or institutional traders are utilizing options to help finance their trades. So look at the matrix of this particular trade and look what would happen. I wrote this down for you guys because I thought this trade strategy, I really like that trade strategy for a short-term play to the upside. They collected, you know, at the time, it's a 64 and 27. I thought it was 40 cents, so I might be wrong. So excuse my incorrect writing here. So I'll correct it for you. They collected about 30 cents, it looks like. So that's 60 cents. So actually, this changes the matrix here by about 220.95. It only adds about 20 cents to these numbers. But I think it's close enough for government work, if you excuse me. Please excuse that one, but it's close enough for government work, all right? What's the moral of the story? They bought a bull call spread, and they sold a call spread twice as much to help finance the market because they don't believe the market, and this is key, is going to get much above 219.5. In fact, if the market gets just up to 220, the maximum that they can make on this market is, as we now know, what? $250 per unit minus the 20 cents, so 230, right? So 230, and the maximum loss is going to be about 170. So if the market goes up forever, for whatever reason, up forever, the market goes to 228 in 3 weeks after on top of an already lofty move. This is a pretty savvy trade. I love this trade. Using markets of money, it's an efficient trade, and I think it's targeting the realistic approach. And what I'm looking at, and why I like that, is it kind of mirrors and matches, kind of like rather than try to focus whether a stock's going to be a binary event and meet, beat, by how much and by when on earnings, this is more of a really neat trade in the sense that they're playing off thinking that it's going to be very hard by August 22nd for the market to go much beyond a 9% year-to-date gain in the market. So, Thomas Leong, thank you very much. Give or take 10 trillion, it's close enough for government work. Thank you very much. Appreciate that. So, trading strategies and using more efficient risk capital is really what's kind of cool, and giving ourselves all a chance of making money is really what this is about. Why? If we could take people who understand option analytics and teach them technical analysis techniques, efficient, advanced, I think you have a really powerful combination. A lot of spreads and things that we teach, like ratio back spreads, more efficient ways of trading directional plays in the market, I think are pretty cool. No one's going to say that they could be right, and this is just kind of one way of playing the market in a very, very efficient and small way with a defined risk, a high probability that the market's not going to trade much above 220 or 221, or excuse me, 220.80. 220.80 in 3 weeks. 220.80 is the break even. 220.80. So I mean, wow, can you imagine? 220.80 is where the market has to be at expiration. This to me is a very defined trade, and based on those numbers, based on what my work says, right, we could see a short-term pop in the market. Now what I'm looking at doing is I'm thinking that over time the market has a shot of going up, but I don't think it's going to be sustainable. And that, in fact, I'm thinking the market will be by, let's say, end of August or earlier, I think the market is going to be back down around the 210 area. Some of our other strategies that we're looking at is the 213-207 strike, 213 for October, very likely stepping in to have something on the market. I think that because of the fact of where we are on a year-to-date basis and over the next 3 weeks, we have a shot at the market possibly moving up first and then down. So I think this was kind of a cool strategy. Number one, if you're not familiar with this as an option strategy, when you see something like this on the board, to me, not many people are buying 100,000 and then someone else buying 200,000. What we want to look at tomorrow, now this is important, this is why I've recorded this is why I've got this photo here, okay, for 2 reasons. We're going to see exactly if the open interest, guys, if the open interest, which is, 100,000 of all strike prices with only 13,000 open interest, and then 100,000 over here with 108. I want to see if the open interest expands tomorrow. Now look at this. This is kind of interesting. The open interest over here on the 220s is 352. The open interest over here at the 222s is 272. So those are some pretty big open interest, and in coincidence, pretty big numbers with the volume. So if we see the open interest tomorrow expand, get more positive to like this degree, that tells me that wasn't a day trade. And remember, for every buyer, there's a seller. And it's not just looking at increased volume, it's looking at whether or not the volume translates to an increase in the open interest. And that'll tell us that this is an established position. Okay? So, number one, I think it's kind of important to look at the market in the sense that some trader, anyone plopping down those types of sizes, of one strike price and in one particular option is pretty impressive. So for target trading techniques, if you feel comfortable that the market's probably not getting much above 219.5 to 220 in 3 weeks, that's a pretty defined strategy, using the market's money to help finance your trade. And if you're wrong, what the hell? You don't have a lot at risk in the market to begin with. 20 cents, is not a big deal of cost on 100,000 contracts to make 10 times or 15 times the money. Anyway, these are the kind of things that the only reason that I even caught on to that today, of all days to catch on to this, right, is, the market's gone sideways. And we're kind of, you got to admit, the spiders are going sideways. It's kind of dull. Nothing's really going on. And people are focused on Facebook. And people are looking at Amazon and Google and getting all excited about that. And meanwhile, someone's putting on and building up a position of considerable size in the options on the spiders. So I thought it would be just almost like, God, what a great way to do a webinar to help share people ways of not only trading the market, but also identifying trading opportunities. So that, to me, is another strategy that one can employ. This is a strategy that we put out. And I wanted, before we leave and conclude, we've had a pretty good year this year. And some of you have joined us with our thoughts and observations. This is something we put out every week. And we made this offer before, and I want to make sure you guys get a chance to look at this again. So we do a weekly thoughts and observation. It's my weekly work every single week. I made this offer, and I'm going to do it again. It's $49 a month. That's every weekend you get a report. And the report kind of looks like, well, actually, it looks exactly like this. So I'm just going to dive into this week's thoughts and observations. This is kind of what we look like. Like Qualcomm, a little trade we had in Apple before earnings came out, kind of the information that we put out. Amazon, by the way, I was looking at between, technically speaking, we were near monthly, quarterly resistance and over these time frames for Amazon. What I was looking for was the market early in the week to rally. This 74.5 straddles were kind of like pricing in the market about a $55 move. And what I was looking at and hoping to see before earnings was the market to run up before earnings. Now, as you know, the week we started to sell off, and then we mildly rallied right back to where we started the week. So Friday, the market, closed here. We traded down Monday, Tuesday. Today, we kind of were unchanged on the week before earnings came out tonight. But my guess was that we were not going to see a market get above that level, and I was looking at, with this type of information, and I was looking, if all well goes well, I was actually looking at doing an out-of-the-money OTM call spread for the August 5th weekly expiration. Under the wrong conditions, the market didn't get there for the under the right conditions. So for the wrong conditions, we didn't do the trade. All right, but with that said, these are kind of some of the ideas that we put out. And last week we talked about we had a lot of buy signals in auto parts, like O'Reilly, for example, things of that nature. So we really go through a lot of the different stocks, retail apparel. We did take profits in Under Armour, which had earnings. Now, this was written, by the way, this was written on 7/24. So this is actually last week's observations. So more importantly, what we try to do is attractive risk-reward opportunities, give you actionable trades, option strategies as well, email alerts, updates, seasonal sector trends. You may have seen that we have the commodity spread trades up there, which is, by the way, if you like commodities, these are the commodity spreads that have over 80% probability of success over the life of history of those spreads, meaning corn, wheat, bonds, notes, etc., etc. I go through sector performances to exploit, maybe overbought, oversold. We give you important support and resistance based on my indicators and other types of moves. We've had some, in June, we had all kinds of pretty exciting trades. We've done pretty well. Some of you guys know this. I'm being humble because, knock on wood, you never want to really brag that much. We talked about the long trade in Ralph Lauren, giving specific things. In fact, just in this month alone, since we last met, we talked about a leap in Morgan Stanley. This is ridiculous. January 2018 for under $1 in Morgan Stanley, those options traded at $1.39 this week. I mean, that's stupid. I know, but it really, I think, gets people exposed for something moving up. Long Qualcomm from 11/7, the July 11th, newsletter. We're out of that trade. Long trade in Fifth Third. Now, I want to discuss this a little bit. Fifth Third, we got in that at around 17.95, and I did get out at 18.42. And the reason is, it's up higher, but I didn't want to take a long stock position with less than 50-cent cushion in it in front of Janet Yellen. So she did scare me, and earnings. So it was a small winner, but another one, Long Rec and Palo Alto Networks, and we're looking for the move to 136. By the way, check this out. This was the specific buy recommendation when we were alerting our subscribers before Friday, and this was the trade signal right there, that high close doji on a weekly basis for Palo Alto Networks. So I just wanted to share that with you. The target here, it's almost achieved the target, by the way, which in that particular newsletter, we were looking for 136, and you'll notice the high this week. So it's almost come to the profit objective for that particular trade. TLT puts, we're out of half. Long Apple call spread, we're out of that. And then as of yesterday, we started to lightly, and the key word here is lightly, enter October bear put spreads in the spiders. And I'll actually give the strategy out to you. I don't mind at all. The strategy we were doing was the 213 to 213.7, I think it's 213.7 strike. And what I'm looking at is $1.60. Excuse me, it's 7 wide, it's the 206, just looked it up. So I'm looking at a 7 wide, and this is for October. Now here's what's really interesting. Now this is lightly. Lightly means per 100,000 you're doing 18. If you have 100,000 in equity, 3% of your risk capital, and we gave out a specific formula lightly because I do understand there's a shot that the market could go up. And with today's information, looking at that board as some trader, it actually confirms that the market might just have that extra 0.5% to 1% move left in it, in the spiders, by the way. All right? So I'm just putting money where my mouth is, so to speak, and letting you guys see exactly what's been going on and where this information comes from. It comes from doing our analysis. And I think that when you look at if you're looking at specific trades, if you're looking at what strength and what stocks are coming through, this is pretty phenomenal. Not only, I think, trading experience, but it's also not just institutional grade level. I think if it's something that you're not used to, you're going to grow into it, and you're going to really enjoy trading on the right side of the market. And we've done some really phenomenal stuff, folks. I mean, it's been very powerful, and it's exciting to note and compare like high yield growth to the S&Ps and looking at the correlation between Apple and biotech, right? So we've done we do some pretty snazzy work here, and it's something that you can sink your teeth in other than flipping coins and guessing. In fact, I think we find more opportunities, more high probability trades apart from earnings season than anything else. And I really mean that sincerely. If you're interested, go to personsplanet.com/report. And I think, you know, what I was mentioning to you just a minute ago, guys, this is a chart that we did in June about 6.6 of why we were still bullish on the market. And actually looking for, you know, we're bullish long term. Look at the move relative in volume on high yield growth. I know I gave this to you guys before. I said, if everyone was talking about high yield growth took us down, why isn't anyone talking about high yield growth taking us back up? Remember that? The high yield growth, everyone was talking about, oh my God, it's the high yield growth is, you know, the corporate debt is causing it's going to cause a market crash, right? So it was the fear of interest rates in answer to an earlier question. But no one's really talking about, you know, the growth in the HYG concept of the market, but we were. So I think these are the things that we do put our fingers on. Another thing is a very useful tool is something you might not find often amongst people is looking at the breadth analysis, the McClellan oscillator. This is a weekly and this is a daily. And this actually does help us to uncover overbought, oversold conditions of the market. And it's something that we really do go through a lot of work to substantiate better trades. When I go through breadth and volume analysis, I'm looking at 6 different stock indices every single week. Where are we? What's the strength of the market? What's the weakness? This is all dailies. This is the S&Ps, the Qs, the Russell, the Diamonds, the NICE. That's a daily. And then down below, we have the weekly of the same thing. And we take a look at what's the strength of the breadth? What's the volume? Is there divergences? So do we want to, if you start to see divergence, by the way, while we've gone up, we still didn't, that's why possibly you're seeing inherent weakness in the Dow relative to everything else I showed you today. Anyway, this is the information that I think that if you're interested, you may want to just try a month of this. It's $49 a month. You get it every weekend. We send it out to you on Sundays. When I get very industrial and ambitious, I do it on Saturdays. And just in case you're not familiar with high close, low close dojis, we offered the last time, and I'm going to make sure that you get the same offer. We offered my free trading course, the DVD course on candles and pivots. And a lot of you have found incredible use out of this and applied the techniques here for other swing and day trading. But by taking a test ride here, I feel confident that you're going to enjoy wanting to stay around with us for a long time. And the rest of this year, man, I'm thinking fireworks, baby. And we've got some good stuff and great analysis to help you make better trading, educated decisions. And some good stuff. While we don't put a trade out every single hour, and I don't think we need to, we go through a period where we put positions on, we monitor, manage those trades, and then you go through a period of taking them off, and then look at establishing new positions. So that's the life cycle of how I kind of do things. So if you're interested, I would strongly urge you to take a trial of this. It's $49, and just for trying it for 1 month, at $49, you're going to get the Secrets Trading course. That is fantastic. So with that said, the link is personsplanet.com/report. So, two things that you had, and we'll give you more information. If you wanted to find out more about the style of analysis and trading that I do, we have a 3-day seminar. If you want to give a test drive to our research and get access to that every single week with email alerts, then you know what to do. You can go to personsplanet.com/report. I thank you all for your time. I hope you got something out of today. We try to put out something every single time I do a webinar because I don't like wasting my time and I don't want to waste your time. That's a fact. And I think that every time we've gotten together, I can literally look back and say, hey, what did we talk about and was it worthwhile? Number one. And was it helpful? Did whatever we were talking about come to fruition in the markets? And at least for this month, it did. And I know it did because we wrote about it and we've acted on it. So that's what's more important. So instead of sitting there saying, market's too high, it can't go any higher. By the way, markets can go higher. It's just, will they be able to sustain that price move? And that, I think, we could see a few-day flop to the upside, or at least over the next, say, let's call it 12 trading sessions. 12 trading sessions does what? It's like 2.5 weeks into, and it puts you into mid-August. So anything can happen in 2.5 weeks in this world, right? With that said, if you're interested in coming down, or if you are in Florida, you definitely want to try this seminar. And that's how I think a 3-day event and mingling with other students is fabulous, especially as we put trades together and discuss things such as the ratio back or the trade strategy that I'm pretty sure was a pretty powerful trade that an individual did today. So with that said, thanks everybody. Charles M. says always worthwhile, and definitely we will go through a lot of this stuff. Jim B said John should be charged. Jim B, you should be charging $250 a month for this report. Thank you. How do I adjust those daily pivots in TradeStation? You only get those dots in the day, doesn't it? Yeah, because those are the free one, Tony. Those are not those are the free daily. That's why they're daily, my friend. If you want the other one, take a trial on TradeStation. If you go to TradeStation, if you go over to TradeStation, Trade App Launch, if you go over to TradeStation right here, to the Trade App, and if you go to the Trade App Store, I think this is what you're referring to. The person's pivots, well, if you type in my name and go John Person, right? I think what you want to do is take a free trial to the person's Pivot Advanced Trading System. If you want the triggers, you can take a free trial there. Or if you open an account with Thinkorswim, you get pretty much the person's pivot triggers for free on Thinkorswim. Okay? So, with that said, it's ironic because here we have another feature here which we are running our scans. Ironically, I think I just take a little quick gander with you guys, if you don't mind, and say, what did today do? Where did we find a majority of buy or sell signals for tomorrow? We got some, nothing really populates off the chart here. Bungie in the ag space, of course, earnings and financials, nothing really. Starwood Properties, nothing really populated much there that captures my attention. Kimco Realty, which is an real estate investment trust, they had earnings. Let's review. I've never even seen a Kona Grill. And again, Amazon, well, all right. I think we could take a Pasadena, as they say in California on that one. Let's take a gander of sell signals real quick. Anthem is a financial, what the heck is this company here? Insurance, accident, whoa. That's kind of interesting because let's take a look at the insurance together real quick. Because insurance, last week, Chubb, stock symbol CB, right, formed a weekly low close doji and has thus seen continued weakness for the week. And what's ironic is it's Chubb, and I know we had a few other names in the insurance sector, because the KIE, the insurance sector, KIE, by the way, the KIE is starting to see a little bit of inherent weakness on the rally. And how I know that is because we have a few indicators here. One, this is a proprietary volume indicator. And basically, it's showing a loss of momentum. This is based off of what? Volume only. This is on balance volume. And what's ironic in the insurer sector, you know, while we don't have an official sell signal, it's starting to lose its positive momentum. And I am starting to see a lot of stocks within the insurance sector start to kind of flip. Chubb was one, Allstate's losing its momentum, and here's Metropolitan Life. I mean, what do we need to say about, you know, Snoopy, right? I mean, he hasn't even joined the party, so to speak, with his brethren stock fellows in that sector. So, any event, that's one. Coach, interesting. Coach did generate today a little daily sell signal. I don't like Coach with this type of pattern, to be truthful. Look at this. Volume's weak, and it made newer highs. So to me, that's kind of a little troublesome on Coach. It generated a daily sell signal today under additional weakness of volume. We had, let's see, Schlumberger, Steris, Lennar, all generating some, and Lennar, by the way, runs into the risk of a weekly low close doji. The housing sector, ITB, let's take a look. ITB is, again, great concept. Remember I told you guys, if you're at or near a pivot resistance of an actual sector like ITB, start running scans in that sector and see if you start populating a lot of daily sell signals. If you start getting sell signals in the housing sector, guess what? Then that tells me it's not one stock specific. It tells me it's more of the, and here we are. Here's that sector. So I can take a look at this and say, you know, today Pulte Home Group generated an official PPS sell signal, as did Lennar, because it's blinking and it says down. That means that's a fresh new daily sell signal in that market. Lennar being at risk of a higher degree time frame sell signal on the weekly, but it's not confirmed. Anyway, this is the kind of stuff that we put out when I give you guys this type of information, and I think it's on a week-to-week basis. It's very powerful. So anyway, Tony, if you're interested, you go to the trading app store. If you want to get a trial to this, this is the advanced page, and this advanced page will get you my pivots, the status, and while this may look complex, it's very powerful, and it is a incredible trading tool. Notice that in just a flick of a switch, I can tell you how many stocks are at currently monthly pivot and sectors. See this gray? This means all of these sectors like XRT, it's at resistance. IBB, it's already at resistance. And by the way, IBB, a little scary here, guys. Look what it just formed or is forming right now. A weekly doji. This is a daily doji. So in the next couple days, we run the risk of maybe a potential triple top. What that means is we might get a little bit launch up, and if it's not sustainable, it could see a little downside. I got a volume divergence pattern setting up in IBB, so this is another, you know, stuff that I will be putting out on our weekly thoughts and observation and looking for specific trades. So when this stuff fires off these buy and sell signals, that's what I put in the weekly thoughts and observation. So I hope you got something a little out of that. And if you want to take a spin at this, it is personsplanet.com/report. Now, as promised, I just wanted to put that up there. It's right here, Persons Planet / I'll post it in here. Just put that in there for you. and you can take a spin. If you sign up as promised, we will give you the copy of my Candlestick, just to get you as a trial. You know, and that's, I think, something that you will find that's incredibly valuable. One other thing that if you wanted to pay for the whole year, you know, next month you try it 1 month for $49. You get the secrets. If you wanted to buy the whole year in advance, $489. We'll include my secrets advanced traders course for equities. Anyway, that's to help you, the trader. This is a fabulous way of trading in the markets and get some solid, substantial ideas. Anyway, thanks everybody. Tony, how do you enjoy it? You can. Have you gotten something out of it? Getting used to the style. Okay. Well, hopefully, you know, you were there to get the apple spread. We got out at the apple at the right time. I'm sorry for the small profit in fifth third. Janet Yellen scared me, man. Sorry. She tends to do that to the financial markets. Why take inherent risk over the market? We're trying to define risk for people. All right. Well, Tony, thank you very much, and I'm glad that's working for you, man. All right, everybody. Thank you all. Have a great evening, and boy, what an incredible month. And pay attention to those. At least watch that the potential for the short-term pop in the market as we get into the August expiration. I'll see everybody the next time. Have a great, great weekend. Bye.